Most people never realize this, but one quiet decision about your house can undo decades of hard work. It is not a flashy mistake. It does not feel risky. In fact, it feels responsible. And that is exactly why it is so dangerous. I have seen families lose enormous amounts of money, not because they were careless, but because they were trying to do the right thing without understanding how the rules actually work. I am Kevin O'Leary. I have spent more than 40 years dealing with money, businesses, and long-term planning. I have worked with families who struggled and families who had more wealth than they ever expected. And I can tell you this with absolute certainty. The biggest financial mistakes usually come from misunderstanding taxes, not from bad intentions. Across the country, millions of homeowners are sitting on far more wealth than they realize. Many of you bought your home decades ago. Maybe it was the early 1980s or 90s. Back then, prices were reasonable. You stretched to afford it, but you made it work. Over time, you paid off the mortgage. You fixed things when they broke. You raised your family there. Today, that same house may be worth 5 times what you paid for it. That house is no longer just shelter. It is your largest asset. For many families, the home represents more than half of their total net worth. That means whatever happens to that house after you are gone will have a massive impact on your children. And this is where things often go wrong. People start thinking ahead. They want to make things easier for their kids. They want to avoid delays, legal fees, and complications. Someone says, "Why not just add your children to the deed now? It sounds clean. It sounds efficient. It sounds like common sense." It is not. Adding your children to the deed while you are alive is one of the most expensive estate planning mistakes you can make. I have seen it cost families tens of thousands of dollars. In many cases, it costs well over $100,000. And what makes it worse is that people usually do not realize the mistake until it is too late to fix. Here is why this happens. When you put your child's name on the deed, the law treats that as a gift. And gifts follow very different tax rules than inheritances. This all comes down to one simple concept called cost basis. Cost basis is what you originally paid for the property plus the money you spent improving it. That number matters more than most people understand. Let us walk through a simple example. Imagine you bought your house for $100,000 many years ago. Over time, you spent another $90,000 on improvements. New kitchen, new roof, updated bathrooms. Your total cost basis is $190,000. Now fast forward to today. The house is worth $750,000. If you add your child to the deed while you are alive and they later sell the house, the government does not care what the house is worth today. It cares about the difference between the sale price and that old cost basis. That difference is treated as profit, and profit is taxed. In this example, your child would owe capital gains tax on more than $500,000. That tax bill can easily reach 6 figures once federal and state taxes are added together. All because of one decision that was supposed to make life easier. People usually make this mistake because they are trying to avoid probate. Probate is the court process used to transfer assets after someone passes away. Yes, probate takes time. Yes, it costs some money. But here is the reality. Probate costs are small compared to the tax damage caused by gifting a house too early. Avoiding a few months of paperwork is not worth sacrificing a large portion of your children's inheritance. And taxes are not the only issue. The moment your child's name goes on the deed, your home becomes exposed to their life risks. If your child, because of a car accident or business dispute, your house is now part of that risk. If your child goes through a divorce, the house may be treated as marital property. If your child has financial trouble, creditors may come after it. You also lose control. Once your child is on the deed, you cannot simply remove them if circumstances change. You may need to sell the house later to cover medical expenses or long-term care. If your child does not agree, you are stuck. I have seen parents trapped in situations like this late in life, dependent on the decisions of others. None of this is hypothetical. It happens every day. So what is the correct approach? The key is understanding that the tax system already gives you a powerful advantage if you use it correctly. That advantage is called the step-up in basis. When you pass away and your children inherit your home, the cost basis is reset to the market value on the date of your death. That means the years of appreciation disappear for tax purposes. If your children sell the home at that value, there is no capital gains tax. Using the same example, if the home is worth $750,000 when you pass away, that becomes your children's new starting point. If they sell it for that amount, they owe nothing in capital gains tax. That single rule can save a family an enormous amount of money. Now, some people worry about probate. That concern is understandable, but you do not have to choose between avoiding probate and protecting the tax benefits. A revocable living trust allows you to do both. With a trust, you remain in full control of your home while you are alive. You can sell it. You can refinance it. You can change beneficiaries if needed. Nothing about your day-to-day life changes. When you pass away, the home transfers directly to your beneficiaries without going through probate. At the same time, your children still receive the step-up in basis because the law treats the home as part of your estate. This is why trusts are so widely used by people who understand long-term planning. It is not about complexity. It is about clarity. Yes, setting up a trust costs money. But the math is simple. Spending a few $1,000s today can save your family hundreds of thousands later. There are very few decisions with that kind of impact. Some people worry about estate taxes. For most families, this is not a real issue. The federal estate tax exemption is extremely high. Unless your total estate is well into the millions, estate taxes are unlikely to apply. The real threat is unnecessary capital gains tax caused by poor planning. If you already made the mistake of adding your child to the deed, it may still be possible to fix it. An estate planning attorney can help unwind the situation and put the proper structure in place. The worst thing you can do is ignore it and hope for the best. Estate planning is not about being clever. It is about being careful. The rules already exist. Your job is simply to follow them correctly. Your home is probably the most valuable thing you will ever own. You worked for it. You maintained it. You protected it. Do not let one misunderstanding undo all of that effort. Hold ownership during your lifetime. Use the right legal structure. Let your children inherit the home the smart way. That is how real wealth is preserved. That is how families avoid unnecessary losses. And that is how you turn decades of hard work into something that truly benefits the next generation. If there is one lesson to take from all of this, it is this: doing nothing is often safer than doing the wrong thing. Do not rush to simplify something you do not fully understand. Take the time to get it right. Your family will thank you for it.